I want to welcome Gillian Edgeworth, a good and old friend of both PEFM and also of CSOX. Gillian began her career at Deutsche Bank, I think, is that right? And then you worked for UniCredit, where you became expert in Eastern Europe, and that's when we relied on your help with a lot of our CSOX conferences and seminars. But then you became involved also with the PEFM program with Max, and you're an associate at PEFM, and certainly a loyal supporter. And today, you're going to talk about Ireland, the case for an adaptive approach to macro management. We've had several seminars and conferences on Ireland earlier in this year, but mainly focusing on Ireland and Brexit. But I think today you're going to talk more about the development of the Irish economy in the context of the EU, the problems that they face and the challenges that lie ahead. But I dare say you may also touch on the intractable problem of Brexit, for which no one has yet come up with any conceivable solution. So I'm going to hand over to you now, and I'll just remind everybody that the discussion, the formal presentation is on the record. It's been recorded with podcast, but the Q&A afterwards is on Chatham House terms. I forgot to mention that you're now working for Wellington Asset Management,
yes.
Which is a slightly different kind of environment from your earlier career. But anyway, possibly
which asset management? Sorry, which asset management?
It's called Wellington.
What?
It's called Wellington. They're a Boston-based firm.
But you're based in London. Right?
Yes.
Yeah. Okay, Gillian, over to you.
Okay. Well, first of all, I'd like to say thank you very much to PEFM for the invite today. Let me start with just a quick summary or layout what I would like to put forward today. So, I guess firstly, what I'd like to say is that I do believe that the business model that was introduced into the Irish economy is unusual. It is an economic success story. It is not standard for countries to close the gap and converge the way Ireland has. I think that was due, at least in part, to the economy's ability to leverage globalisation. I think where Ireland fell short on the macro management slide was that in the lead up to the global financial crisis, there was little in terms of discussion or macro management on the potential for negative spillovers from globalisation. So while I think that the positives from the business model that's been introduced significantly outweigh the negatives, there is still considerable scope for negatives, and they do need to be managed. I think we're at a very interesting point in the Irish cycle right now. So the downturn is in the past. I think the economy has moved out of its repair phase. It's firmly in its recovery phase, and I think it's moving into a phase where parts of the economy are running a little bit hot again. And combined with that, I think simultaneously the economy is facing some challenges to its business model. And there I would highlight Brexit, and I would also highlight what's happening on the international side in terms of corporate tax rates. And I put all that together, and I argue that the case for a much more active and adaptive approach to demand management or macro management is necessary. Finally, I would argue that best in class is not enough. Ireland made the mistake in the lead up to the crisis of comparing themselves to the Eurozone, for example, on the Stability and Growth Pact. That wasn't enough, and I don't think it will be enough going forward. So best in class is not sufficient. It needs to be better than best in class. So let me start just with the convergence story, or with the catch-up story. So when I think of the Irish economy, the pace of catch-up, I guess really if you look there between the mid-90s and 2006, is very unusual by international standards. So they narrowed the gap, Ireland, by about 2 percentage points of GDP per annum, depending on how you aggregate up EMs. But if you exclude China, Ireland was converging at basically 4 times the pace that a standard emerging market does. So very, very successful, very rapid catch-up. Some of the academic research will tell you the lower your starting point, the more likely you are to catch up. In reality, that doesn't happen some of the time. We can see that with countries like Greece, we can see that with countries like Portugal, but Ireland, it did happen. Not only did the economy converge towards advanced economy living standards, the economy managed to go beyond that. How was it achieved? Again, it comes back to, I think, leveraging globalisation or developing a new business model for the economy. It's a country located between the EU and the US. It was able to take advantage of a rapid acceleration in global trade. It did that in part because it offered a cheap, well-educated and young workforce. Many of these globalisation trends emerged at a time when the economy was coming out of a period of austerity. I haven't been able to find research to suggest that the peace dividend or the 1998 Good Friday Agreement played a significant role, but I think it's worth mentioning. And finally, of course, the Eurozone entry into the Eurozone lowered the cost of financing for both the public and private sector. At this point, Ireland is the 16th most important or 16th largest attractor of FDI globally. In per capita terms, it's the 10th. And in terms of the stock of FDI present in Ireland, it's larger than it is in India or Italy, which are obviously much, much larger countries. So I keep on coming back to this idea of leveraging globalization. And I think that you can see that from one perspective, which is exports on this slide. So exports in 2014 are almost 8 times what they were in 1993. That's goods and services, and I think it's quite important that there is some pretty significant growth in the services side as well. That significantly outstrips what we've seen in other Eurozone countries. Spain is second, but it's almost half of what we have in Ireland. I am purposefully omitting data from 2015 onwards here, and I'll come back to the reason why, but it has to do with the fact that there's such a reliance on multinationals in the economy. This part I think is important, but financial openness I think is also key. So Ireland took advantage of the sharp increase in global trade. I'm not sure you can say taking advantage of the sharp increase in financial globalization is exactly the right way to put this. I think the right metric here is excluding the IFSC, which is the International Financial Services sector in Dublin. So that's essentially, I guess, a lot of financial services companies that have very little to do with the Irish economy present in Dublin. But even when you adjust for that, you have foreign assets and liabilities, I think the most common measure of financial openness, which is not far off double the Eurozone standard. So it wasn't only that trade grew, it was also that Ireland's reliance on foreign capital flows grew very significantly over that period as well. This, I think, was much less discussed.
What's the net figure? Because that's adding up assets and liabilities.
Yes. The net figure is still quite a significant negative. I don't have it off the top of my head, but it has improved. And when you put all this together, what you have is an economy where, on average, global growth was well in excess of what you saw in the Eurozone that was necessary to generate the convergence. But I think it's also more volatile. And it's also more vulnerable to exogenous shocks. So essentially the booms are bigger, and unfortunately what we saw, not necessarily going to be the case going future, but the bust was definitely bigger as well over the course of 2008 to 12. One of the ways to think about this volatility, I think, is captured in that data from 2015 onwards. So Ireland managed to post growth in excess of 25% in 2015. Quite an impressive number by any sort of international standards. But really what this is capturing is just how open and integrated the economy is into the global economy. So what happened is we had a change in accounting standards for GDP. The capital stock increased by about 300 billion euros. roughly and that's about 35% of an increase in the capital stock in 1 year. And what was happening is that the economy was forced to include within the capital stock intellectual property being developed in Ireland that had very little to do with the Irish economy itself, was generating a lot of export growth, but it needed to be captured in the domestic data. That pushed exports up by about 70 billion or 36% of GDP as well. So we're at a point where its integration into the global economy is sufficient enough that it is significantly distorting what traditional headline macro metrics will tell you about what's happening in the underlying economy. You will see something not as pronounced, but you will see something similar in the current account data, where it offers you very little insight at this point, at a headline level at least, in terms of what's happening in the underlying economy.
And that 25% growth in 1 year is a surreal number, isn't it? And it's just a re-evaluation.
Yes, it's an accounting methodology or an accounting change essentially, but it's still in there every year. So what I guess look at afterwards is when you think about private credit to GDP, when you think about the budget balance as a percent of GDP, when you think about the current account, it means less in Ireland than it does in most countries, because GDP is so inflated by economic activities that do not capture the underlying strength or weaknesses of the economy itself. So I think this is the success story, but it's one with vulnerabilities, and that requires, I think, active use of demand management tools. To me, that didn't happen in the lead up to the global financial crisis. And I guess one point that I'd like to make is we're dealing with a very small economy here. So you have a US, 2 to 3 multinationals from the US come in and set up business in Ireland. They can have quite a significant impact on macro numbers. You have a small group of European banks decide to increase their exposure to the Irish economy. You can have quite a significant impact on Ireland's numbers without necessarily having an impact at a European level. What I've done here is this does not capture the economy as a whole, but essentially I think one of the things that was not discussed in the lead up to the global financial crisis was the need to grow your tradable sector or your non-tradable sector in line with your tradable sector. And essentially what happened was that within a very short period of time, so if you look at this here, it's really 2004, 5, 6, 7. So within a 4-year period, your growth in non-tradables significantly exceed growth in tradables. So the economy became, as a source of growth, much more reliant on construction, on real estate. And I put public administration, education and health in there because I do think that the public sector and the extent to which fiscal policy was stimulative had a role to play in growth in non-tradables also. The flip side to that is that as competitiveness was eroded, your traditional sources of more sustainable growth, industry, transport, information and communication, that's a lot of IT, which is very important to the Irish economy, professional and support services, they dipped so that they were growing at a slower pace than the economy as a whole. This is not a perfect measure of tradables versus non-tradables. In part, again, there are data issues, but I think this captures some of the vulnerabilities, at least somewhat accurately.
What's the Z-score measure?
So it's just standard deviation, so how many standard deviations you are away from the average. If that makes sense. So by the time, at its worst, the non-tradable sector was growing at 2 standard deviations above its average, if that makes sense.
Growth rate.
Yes.
So they're not growth rates, so the deviations.
Yeah.
Growth rates from average. Right. Thanks.
So where were the, I guess, where did demand management fall lacking? Where did Where did it not work? And how did we see such a rapid boom followed by such a sharp collapse? I think this part of this crisis is very well understood. You had private credit as a percent of GDP more than double, again, within a very short period of time, 4 to 5 years. I think what's striking for me is the transactions number here. So you had 4 to 5 years of a boom, and there's now 7 to 8 to 9 years of a contraction in credit. So what goes up must come down. And it unfortunately comes down for a lot longer than what it goes up by. The second part for me is less well discussed. So from a real economy perspective, I think this is very important. From a financial cycle perspective, I think this is important. And I think this was central to Ireland's loss of degrees of freedom, essentially, in negotiating a programme. And loss of degrees of freedom when considering or designing the policy response to the crisis. So there's been a lot of discussion on whether or not the senior debt should have been paid. There's been a lot of discussion on whether the sub-debt should have been paid as part of the crisis. One of the ways, obviously, the economy, non-tradables growing in the excess of tradables, running a current account deficit, booming credit growth, that had to be financed from somewhere. It was financed from abroad. So essentially what happened is that you had non-resident deposits in the system rise from more than double, again, over that period of time, about a 5-year period of time, and then fell very rapidly. So what took 5 years to accumulate took about a year, 18 months, to reverse. And that essentially generated a huge reliance on Eurosystem funding, including via ELA, Emergency Liquidity Assistance. So when I think of the timing of the programme announcement and when I think of the design of the programme, this loss of freedom and this increase in reliance on official sector funding, to me, removed a lot of the degrees of freedom that the authorities had. And this, I think, is something that's very important to monitor going forward. And the last piece of the puzzle that I think hasn't been discussed in enough detail, and I'm not suggesting Fiscal was at the core of the issue in Ireland. I don't think it was. I think it was a credit issue. But I think Fiscal played a role to play, or had a role to play. And it played that role essentially by, again, contributing to growth in non-tradables, which was not sustainable. So if you looked at the headline numbers in Ireland in the lead up to the crisis, Ireland was a very good student by European standards. It not only adhered to the Stability and Growth Pact, it beat the 3% deficit target most years, and some years it ran a surplus. If you look behind the headline numbers, though, what you'll see is that fiscal policy was very pro-cyclical. So as a percent of GDP between 2000 and 2007, expenditure barely changed. In real terms, the public sector wage bill in 8 years went up 80%. Current expenditure in real terms between 2000 and 2007 again went up almost 80%. And why? I think in part because the success that was real convergence materialized so rapidly that there was never really a public discussion on the role of fiscal policy in terms of demand management.
What's interesting is the other charts generally show that although there was rapid GDP growth from 1998 to 2003, other things were not going wrong. So
yes.
But what you're showing here is that even during the 1998 to 2003 period, there was already an increase in the public sector wage bill, but it was perhaps more sustainable and justifiable because it was supported by a tradable sector and, and a fiscal inflow that was sustainable. Yes. 03 to 07, it was credit based and therefore
a lot less sustainable. And I mean, there's been a discussion on to what extent did public sector wage growth lead private and vice versa. And again, I'm not suggesting in any way that the public sector wage bill or current expenditure in real terms should have been unchanged between 2000 and 2007. But again, the case for the sort of growth we saw is also a lot less convincing to me. Just to give you a sense, I put this table together, I don't know if people can see this here, but if you had kept current expenditure unchanged in real terms between 04 and 07, expenditure would have ended up 10 percentage points of GDP lower going into the crisis. There would have been some very significant differences. And when you look at where Ireland is ranked there, it's very much ranked amongst the newer EU states where there was very, very large booms also. Lastly, I just wanted to mention, and I didn't include a chart here, I guess my takeaway from some of this is one, domestic demand management policies weren't what they should have been. Two, European rules didn't work. But also three, I would say that the role of the market in terms of discipline on policy was also very weak in the lead up to this. And even today, I do believe that relying on the market as a disciplining mechanism is not a viable strategy for macro management. So to give you a sense, in August 2008, the month before the government came out and guaranteed banking sector liabilities well in excess multiples of GDP, Irish 10-year bonds had a spread to bunds of 29 basis points. In October 2008, the spread was 37 basis points. So the market basically added an 8 basis point risk premium to compensate for a guarantee equivalent to multiples of hundreds of percent of GDP. In July 10, by that point, there was a differential. So at that point, the spread was at 185 basis points. But again, in a small open economy like this, things can move very rapidly. And by November 11, that was at 690 basis points. And the sovereign arguably couldn't access private sector markets.
But what was it in 2011?
690 basis
that was
points.
the big rise.
Yeah. So that, I guess, in a way is my diagnosis of some of what happened and contributed to the crisis in Ireland in the lead up to 2008 to, let's say, 2012. The economy is at a very, very different stage now. In part, I think, capturing the fact that the economy does enjoy, I think, a well-established and viable business model. And I would contrast with that with some of the other countries that were called Eurozone periphery as well. And I think, but also capturing the extent of the decline in the economy, it's bounced back very, very rapidly. So the Central Statistics Office is now publishing data which tries to modify domestic demand for some of the changes in accounting standards that were put in place in 2015. And essentially what you're seeing is underlying domestic demand has averaged in excess of 5% roughly since 2013. So by any standards, a very strong recovery in economic activity. Again, firmly out of the downturn stage, firmly out of the repair stage of the economic cycle, definitely in the recovery stage and arguably moving into the expansion stage where the economy is showing signs of excess or parts of sectors of the economy are running hot, I think, at this point. This, I think, captures that as well. So we're just about 2 percentage points above the lowest unemployment rate pre-global financial crisis. So it has been a creditless recovery, but there are parts of the economy that have strengthened significantly. For me, this in itself argues in favour of a discussion on demand management tools, the extent to which they should be coordinated across central banks and ministries of finance at this point. There are two other developments exogenous to Ireland that I think strengthen that case much more. So the first is Brexit. Ireland is more negatively exposed to Brexit than I think any other EU country. The ESRI has done some very good work on this in Ireland. And in the WTO scenario, so in the hard Brexit scenario, the ESRI is basically arguing that GDP will decline by 4%, close to 4%, 3.8 relative to the baseline. this to me, this sort of scenario is a cyclical risk. It's not structural. Potential growth in Ireland is put at about 3% per annum. So you're essentially taking just over 1 year's potential growth out of the economy over the course of a decade. It's unfortunate, but it doesn't change the trajectory for the economy if you can manage it over a 10-year horizon. And for me, the challenge to policy is that it's much less likely to happen over a 10-year horizon, and it's much less likely to be smooth. And this feeds back into the globalisation model and leveraging globalisation. I continue to think globalisation moves in the right direction, but it's no longer a one-way street. And it bolsters the case for more active macro management. If we were to get a WTO scenario or a hard Brexit, to me the risk is that you see the impact on the UK economy and you see the impact on the Irish economy more suddenly or in a more concentrated period of time. So just to give you a sense of the exposure of the Irish economy to trade and services, again I want to warn that relative to GDP, these numbers are all relative to GDP, and because of the revisions they are distorting some of the numbers. But the UK is a very important trade partner for Ireland from both a goods and services perspective. From a goods perspective, exposure has fallen. From a services perspective, it is more important at this point. That's transport, it's financial services, it's agriculture, within goods, but within services. A lot of it is information technology, transport and financial services. Ireland is more exposed to the UK than the UK is to Ireland. So it runs a negative trade balance with the UK of about 1% of GDP. It runs a positive services balance with the UK.
So overall, it's actually overall positive, put the two together.
Yes, yeah. So you come out net about 3% of GDP. And you have the tourism impact, and this can feed through if there was a decline in activity in the UK, but the pound also has a significant influence here as well. So my concern, or what I would argue, is that in the face of this sort of threat to the economy in the near term, there is a case for a more coordinated response to demand management. 4% over a 10-year horizon is manageable, but if what you were to see over the course of the next couple of years was a more immediate upfront shock to the tradable goods sector, to services, to tourism, and there would be some more focus on the banking system given Bank of Ireland and permanent TSB's exposure to the UK economy, there is a risk that the sovereign comes under pressure for a more immediate policy response. I have put this in here just because I've been doing some work on it recently. I don't think it relates to policy in the next decade, but it is striking that this is a theme that is being discussed a little in the Irish papers right now when it never was in the past. And it would have a significant impact on the shape of the economy in the Republic of Ireland if you were to see the reunification theme play out.
Significant in what way?
Significant to the extent that, again, I should really say, I think this is a low probability event for the next decade, very low probability. But essentially what you would have, I mean, relative to the UK economy, Northern Ireland is 3%. Is 2% of UK GDP. Northern Ireland economy, it represents 14% of Republic of Ireland GDP. The impact on population is larger. Public sector employment is more dominant in Northern Ireland than it is in the UK or the Republic, so that will put pressure on public finances. And the Northern Ireland economy runs a budget deficit which is equivalent to about 30% of Northern Ireland GDP. So the fiscal impact for the Republic of Ireland is larger than it would be for the UK.
Is there, I mean, maybe coming on to it, do you have any estimate of the growth potential from unification, either Republic or Northern Ireland?
I haven't seen how to. I think this. I haven't seen any research done on this.
Because that, I mean, affects the probability. I mean, if it were demonstrated that both would benefit from unification, it makes it less low probability.
Yes. I don't have a smart answer to that.
But given these numbers, would it be correct to say that the idea of reunification is viewed with some trepidation?
It's just poor people
Or not?
I think we're still so early in the debate.
No one's sort of taking a view.
Yes. Yeah.
We need to.
At this point. So what we have is an economy which is showing some modest signs of excess, which in itself argues in favour of a policy response, some of which I really think is coming through. Then we have an exogenous shock that may be there to the cycle in the form of Brexit, which policy should prepare for. And there is a second potential exogenous shock that's coming through, which is potential changes to corporation tax rates and pressure at an international level for this to happen. I'm going to just move forward a little bit and then come back. So again, 1 to 2 to 3 large US firms locating in Ireland can make a very big difference to the economy. Just to give you a sense of multinational enterprises or companies and what they represent the Irish economy, they're only 1.5% of the total number of firms in the Irish economy. They're almost a quarter of employment, and it's over 50% of gross value added. So put politely, I guess, they represent a very important part of the business model for the Irish economy. Ireland, I think, is very committed to the 12.5% corporate tax rate, but there are challenges coming from outside. So one is the US tax bill that's being discussed right now, and that is to bring the corporate tax rate potentially from 35 down to 20. I would like to stress, I don't think the Irish business model is just built on a 12.5% corporate tax rate. I think there is more behind it. I think its location is key. I think the fact that it's the only English-speaking country in the Eurozone is important. It may become the only English-speaking country in the EU. There is a young and educated population there, and there is a very business-friendly environment in place. But the corporation tax rate does matter. This is something I took from the IMF's most recent report. So you have the corporation tax rate on one side, and I have some concerns about some of these indicators in global competitiveness, but you have global competitiveness rankings on the other. To suggest that the global or the corporation tax rate is not an input into this, I think would also be unfair. At a European level, it's not at all clear that this will get very far, but there are also efforts underway there as well. So if you look at there's an effort called the Common Consolidated Corporate Tax Base underway. So multinationals would essentially be required to comply with a single set of rules on corporation tax. You're not required to unify corporation tax across EU or Eurozone countries, but there would be a formula determining what portion of tax countries pay or corporations pay in specific countries. Right now it's suggested on a mixture of the company's asset base, employment and sales. But that sales portion to Ireland is very important because a large portion of sales at a European level are booked in Ireland but not necessarily made in Ireland at this point. Again, there has been some good domestic work done on this. I would highlight the ESRI's work. They estimate if this was to come into place, you would have a 5% decline in FDI flows and almost a 6% decline in corporate tax receipts. So something that's non-negligible and something that isn't essentially or necessarily within the authority's grasp.
Finland and Great Britain seem to be competing for the same spot.
Yes.
You're missing
Yes.
it. Or are they actually on the same place?
So Great Britain has a higher corporate tax rate right now.
But I mean, the dot for Great Britain seems to be Finland. Is that Britain or
Finland, yeah, Finland, Great Britain, and Ireland is in green. I don't know if you can see it.
Britain is-
But I get not enough dots, so too many names and too not enough dots.
So Ireland, I guess, is
It's a
essentially.
green thing, yeah. I see that.
Yes.
Gillian, are these nominal tax rates
Yes.
or effective tax rates?
These are top statutory corporate tax rates.
Right, yes, because of course the effective tax rate depends crucially on the provision of allowances,
Yes.
etc., etc.
Yeah.
Okay, thanks.
Adam, I think Finland and Britain might be on top of each other.
Yeah. That makes sense.
And to put this into, a fiscal discussion, what you have at this point is corporate income tax. Even though the corporate tax rate is low, corporate taxation as a percent of total exchequer returns are high. They're close to record highs right now, and they are in excess of what you see on average in the Eurozone in terms of government revenue.
What would be roughly the average Eurozone revenue percent?
I think it's roughly about 10%.
10%. Okay.
Yeah. So you're looking at 6 percentage points higher
Yeah.
as a percent of total. And I have mislabeled the next chart, but the concentration is important, and this comes back again to 1 to 2 to 3 large investors having an ability to influence macro trends, either in terms of the real economy, but also on the financial account of the balance of payments. So what you have here is the percent of corporate tax receipts accounted for by the 10 largest companies in Ireland. So what you have right now as a percent of net receipts, the 10 largest companies account for 35% of corporation tax payments in Ireland. So without repeating myself excessively, 1 to 2 to 3 decisions can have an impact on headline macro numbers in the economy.
Sorry, I'm getting confused by numbers, not surprisingly. Looking just at corporation tax,
Yes.
is almost meaningless, isn't it? I mean, there's value-added taxes, income taxes, all sorts of other taxes. My guess is that you're arguing that Ireland depends relatively more on corporation tax rather than other things, compared with other countries with taxes, and tax and the rest of it. But by itself, it's almost meaningless, isn't it, comparing, say, Germany or Netherlands or France with Ireland, just in terms of how much is raised by corporation.
So I guess my point is that it's a larger portion of revenue and it's potentially more volatile.
Yeah.
Does that make sense?
Yeah.
Sorry.
So, just to give me an image, what kind of companies are these? Are these Google and things like that?
So it's publicly not disclosed who the 10 largest companies are. Take a stroll around Dublin. Google, Facebook, Apple, large investors. The pharmaceutical industry are large investors also. And then there are some financial service companies that
It's
are
also
invested.
very relevant, isn't it, that the current Commission, the European Commission, has a case against Ireland because it says that the low or almost nil rate of effective corporation tax on these big American internet and other companies. I think the actual case is against Apple, but and this is currently going on. The Commission, of course, are saying that this is a state subsidy. In addition to that, there is a very slowly gathering international movement. I mean, there is progress, but it's pretty slow, which is going to attempt to, as Gillian touched on, basically reach some composition with these big international companies, because the fiddle relates to all the sales, well, not all the sales, but a lot of the sales we booked in Ireland or in Luxembourg, which used to be a favourite by Juncker. And the question is, it's not in the interest of Ireland in particular, as Gillian has said, to attack this, but some sort of compromise might be necessary to keep the companies there paying some sort of almost agreed percentage of tax. But currently in the international context, this is a huge issue, and the OECD is very active.
The BEPS.
My own take on it is that we will see progress in this area, but it will be slower than fiscal purists would wish. But that's just my view. But this is, I totally agree. This is hugely important for Ireland, who, having done this for some years, I forget the year it was introduced, but I think it was in the boom. It's a long time.
The corporate tax rate came down very rapidly over the 80s and of course the 90s, from 40 to 50% down to a low of 10.
And of course there are those who say that the UK should engage in similar predatory tax fixing post-Brexit.
We can take this question up after if she's finished.
I'm so sorry.
No, not at all.
Need to get started.
Let me just, I guess, wrap up with the last section of the presentation. I'm at risk of repeating myself, but when I put where the economy is in the cycle with the Brexit risk and the corporate tax risk, and combine that with the experience in the lead up to 2008, for me there is a case for more active management, or for more active use of demand management tools across the spectrum. So this is not an economy that can use monetary policy to smooth the cycle. It is an economy that can use macro-pru. It is an economy that can bolster structural policies if they so choose. And it is an economy that can use fiscal policy to smooth the cycle. Macro-pru is moving in the right direction in Ireland at this stage. So what we saw in 2015 was the introduction of restrictions on mortgage lending. So for the first time, use of loan to value ratios, use of loan to income ratios, with some evidence that it has slowed lending growth. We're seeing a central bank that is making significant efforts to communicate their policies to the general public, and the use of those policies. And my interpretation of some of what's being published is that the central bank, right now what we have in Ireland is, you can see that they're second from the right here. We've had a huge improvement in the loan to value ratio for the banking system. So in a way, the actual use of macro-pru right now in an economy where there hasn't been, up until very, very recently, positive net credit transactions in 7 to 8 to 9 years is limited. There has been a huge reduction in reliance amongst the domestic banking system on foreign funding. But if we were to see that increase in reliance on foreign funding, again, my sense is you would see the central bank come in and use liquidity and capital ratios to make sure that the pace of that exposure at least is manageable.
Are these mostly domestic banks, or are they other multinational entities in Ireland?
No, this is very different to Central and Eastern Europe. They are domestically owned banks. The system is really dominated by AIB and Bank of Ireland, followed by Permanent TSB. So on the macro-pru side, there are some significant steps forward towards demand management. And I would say that Ireland is leading the Eurozone on this front. On the structural side, structural is always, it can be a bit softer, it can be a bit tougher to assess. My concern here, and I need to correct a couple of things on this chart, but my concern here is that, again, best in class is not enough. So what I've done is looked at country-specific recommendations for reforms that the Commission issues every year under the macro imbalances procedure. How to read that chart? I've labelled the last two bars incorrectly, so that's EU 2016, not 15, and Ireland 2016. What we have seen and what the Commission does every year is they publish progress on reform suggestions, and they are categorised as either no or limited progress, you have some progress, and you have substantial progress. In 2016, and at an EU level, there's been a gradual deterioration. There was no or limited progress on over 60%.
So it should be 2016.
Yes,
Right,
yeah. The last two are 2016,
Yeah.
not 15. There was no or limited progress on almost 60% of the recommendations. There was substantial progress on approximately 5% of recommendations at an EU level. In Ireland's case, there were 3 recommendations. There was some progress made in each of the 3 in 2016. The question is, well, on an EU level, Ireland is clearly an outperformer, but is this enough? And I would argue again, given the extent to which the economy is open and given the exogenous shocks that may hit the economy over the course of the coming years, best in class isn't enough. It should be better. And lastly, and I think this is really where the core of the issue is at this stage, given where the economy is in the cycle, is fiscal. So again, Ireland's back, maybe not top of class, but outperforming the Eurozone. So what we have here is a structural budget balance that has improved at a much more rapid pace than the Eurozone average. And it should outperform the Eurozone by next year. So you've had a very, very large fiscal adjustment in the economy. On top of that, I think you have some very prudent debt management policies which are underway. So in case of a shock, the sovereign is maintaining very adequate cash buffers to try and prevent or try and protect against any potential market pressures. The government is talking about the creation of a rainy day fund, which over time could act as a smoothing mechanism for the cycle.
Yeah.
And on public debt to GDP, again, Ireland is outperforming peers. So public debt to GDP rose rapidly. It's still well above the lows pre-crisis, but it has come down at a pretty meaningful pace. And this is gross. It doesn't adjust for the cash balances the sovereign is sitting on, and it doesn't adjust for the sovereign's assets in companies or banks like Allied Irish Bank or AIB at this point. But for me, I think there is still a question, is this enough? There was a culture, I think, to a certain extent in Ireland in the lead up to 2008. If the money is there, let's spend at least some of it. We're very early cycle from this perspective in Ireland still, but there is some of this creeping in. So in 2015, corporation tax receipts, potentially volatile going forward, surprised on the upside by about 2.3 billion euros. A little under half of that was spent. So there was, within year, shift in the budget to facilitate some expenditure on that front. Last year, corporation tax receipts surprised to the upside by about 0.7 billion euros. There was a very similar trend again. So there was a bias to spend it.
So is this relative to budget then, these figures?
Yes, yeah, relative to budget. I clearly like this chart because I put over. So there is a question mark about, there is fiscal discipline, is it sufficient? We come back to the GDP issue in terms of macro management as well. Ireland fares well in public debt to GDP. Public debt as a percent of revenue, Ireland fares less well. There's still more work to be done on that side. And there is a case, I think, for using different measures of public debt given what's happening with the GDP statistics. So on that front, Ireland is the 4th weakest in the EU. And this is at a time when there has been a boost to revenue from corporation tax. And this is really just to reinforce the point. So this is a chart I took from the Irish Fiscal Advisory Council, who themselves have taken it from the Ministry of Finance, basically suggesting that the Ministry of Finance's own projections show that net debt as a percent of public revenue on their projections is going to remain much higher going forward than was pre-crisis. This is my last slide. I put all this together, and I guess my view is that there is a case for more active management, in particular on the fiscal side, taking a more conservative approach to build buffers to protect against a future downturn, which hopefully won't come soon, but is inevitable in all economies, particularly a small open economy like this. Thank you.